Good morning. Today is Wednesday, December 11th. I'm Joe Terril, President of Terril and Company, Private Wealth Managers in St. Louis, Missouri, with clients, by the way, in 33 states. And this is another update of our outlook for the economy, interest rates, inflation, the stock market, etc. We appreciate you tuning in today, and we will start by talking about the all-important action of the Federal Reserve Bank. This morning's inflation figures came out, and the Fed likes them because inflation is, in their opinion, continuing to moderate. But the figures show inflation continuing to run at over 3% per year. The Fed, in an effort, again in their opinion, to get ahead of the game, is probably next Wednesday going to reduce interest rates by another 0.25%. It's our opinion at Terril and Company this is not necessary, and the Fed's opinion that they have been very tight with credit simply does not hold water. There are plenty of bank reserves out there. You can get all the reserves you want if you'll pay the interest rate. The fact that they simply raised interest rates is not being tight on credit. So we will see if this recent move by the Fed will create a scenario where inflation begins to reignite, or does the Fed know something about the economy that we don't? And the economy is doing just fine right now. You can point to individual pockets of weakness, but when you put the entire thing together, people are working, people are making money. You can see it in the earnings of the S&P 500 companies. No one's really crying the blues about how bad business is, and the economy continues to progress. In our opinion, it will continue to progress in that fashion until the Fed either is forced to raise interest rates or some type of other event will destroy consumer confidence. So we look for the economy to continue to be strong, and I will very quickly turn this over. I'll go to Bill Newbold here to bring you up to date a little bit on our outlook for the stock market, equities in particular. Bill?
Great. Thanks, Joe. As Joe mentioned, we're still bullish on the U.S. economy, and we're bullish on stocks, but we are selective. As he mentioned, the Fed is going to cut rates on December 18th. The next two FOMC meetings are in late January of 2025 and then March of 2025. It's unclear what they'll do yet, but certainly there's been an easing bias. I think they'll take a wait-and-see approach. But as Joe has mentioned in conversations with clients and the conversations we have amongst our investment committee, the markets have had a terrific run. Valuations are high. And we've mentioned before the top 10 stocks in the S&P are trading at quite a bit higher multiples, and we updated the data through the end of November, and we expanded it from the Magnificent 7 to the top 10, and those stocks are trading at just under 29 times current earnings, while the remaining 490 stocks are trading under 20 times earnings. So it's a 9 times multiple difference, and that is where Terril and Company focuses on our, potential purchase stocks. We try and find value for our investors, and quite simply, the top 10 stocks are just too expensive, and so we expand our universe to the other 490. But again, we are bullish, but again, as Joe mentioned, investors are going to be looking for some sort of a Fed signal or some sort of policy change heading into 2025.
Thanks, Bill. Let's talk a little bit about fixed income, quote unquote, bonds. As our clientele knows, we very correctly held all of our durations very short for the past 2 or 3 years. But let me ask Dave Carter to, real quick, Dave, if you will, please make some comments about fixed income. We know that longer term interest rates are unchanged. The Fed's lowering the short term rates, but it has not had an effect on the long term rates. But just chat for a minute, if you will, about what's going on.
You're right, Joe. In fact, since the Fed first started cutting, the 10-year is up. Right now we're at 424 area. It's up from 365 from when the Fed first started cutting. So I think that took some people by surprise. And it is found sort of equilibrium. The 10-year has found equilibrium right here in the 4.25 area. But saying that, looking for opportunities in the fixed income market, there's not a lot of bargains to be had. Yields are very low for the risk that we feel we're taking. We still find attractive opportunities in the hybrid reset market, where we can get 6% plus in what we feel is short duration assets, and if the bonds are not called from us, we'll have a significant increase in our coupon, in our income. We like that. We like that structure, and we like that opportunity. But in general, things are relatively expensive in the fixed income market as far as corporate credits and municipal credits, and that's a sign of the liquidity you've been talking about in the system. So, anyways, that's what I'm seeing right now.
Thanks, Dave. Just some other comments real quick. We're still very bullish on gold. Gold is within a few dollars of making a record high. There are other countries around the world that have been down this path of a year ago. They cut their interest rates. They've had to come back and reverse that and increase interest rates. So we think this will be the key as we head into 2025. We do find selected stocks that we think there can be money made off of over the next year. And as Dave mentioned, finding these reset issues where if they're called away from us, we make 6%. If they're not called away from us, we get a significant increase in the interest rate that the issue is paid. So for the moment, thanks to Brian Curtis, who helps us produce these updates, and a very Merry Christmas to all of our clients and our viewers of these updates. And we'll probably be back maybe with one more update right before the very end of the year. Thank you.